All right, everyone, we'll get started. So thanks again for coming out this evening to our monthly investor meetup. Today, we're going to be covering topic of taxes and real estate investing. We've got a guest speaker here, which I'll introduce shortly. For that, meet the organizers, myself and Anthony, along with Lane, who's a mortgage broker, or put these events together once a month. So we really appreciate your attendance here. This slide's just a disclaimer. Just take a few seconds to read it, and we'll skip to the next slide.
Consult professionals before you
make any advice. Yeah. And this slide covers solicitation. So we understand that there might be other realtors, mortgage brokers, and other industry professionals here, which is fine. But we just ask that you don't promote your services here because these events do come free for you, but they have a cost when it comes to us. All right. That being said, I'm going to hand it over to our guest speaker today, Irfanali Moledina from RMI Accountants. Irf, take it away.
Okay, thank you. So before I start here, how many people currently have an investment property by show of hands? Awesome, thank you. And how many people here are looking at buying another property within the next 12 months? Show of hands. Perfect, thank you. So before I get started with my presentation, is it okay if I tell you a little bit about myself? As Santosh mentioned, my name's Irfanali Bio. I started our firm RMI back in 2011. So over the years, we've grown just a little bit to a point where we've got over 35 people in our Calgary office here, and we've got another team of 11 overseas as well. So a pretty good team that we've built over the years. And a lot of it has actually come from real estate because it's one of my big passions. So we've got a lot of clients who are focused around real estate. I've done a lot of investing as well. So I actually started when I was young at 21, and I used my parents' equity in their house to buy a couple properties in the States. Lost a lot of money on them. And since didn't give up and bought some stuff here where we've actually started to do some much better. So and then currently, just from a real estate standpoint, so not only am I an accountant, but we're in the process of developing a couple apartment complexes altogether. We're in the process, one of them is going to be 21 units on its own, but I own 20 other individual units between partners and myself, between a 5-plex that we have, one 8-plex that we're in the process of building, and then a couple single family houses and a couple vacation homes. So I like to, for those that get to know me, I really like to dip into everything just because then I learn so much more and I become a better accountant that way. So that's me in a nutshell. So today I wanted to, Santosh did give me some questions. So I wanted to make sure I cover off those, but my presentation is not going to be too long because I know when it comes to taxes, everybody's got 50 questions. So I have left lots of time for some Q&A as well, which is good. So one of the first things I wanted to chat about though, incorporation versus a sole proprietorship. So when you own real estate property, obviously you can own it as an individual, you can own it in partnership, you can own it through a corporation. So what I want to touch on is kind of the difference between an incorporation and a sole proprietorship. Now when we're talking sole proprietorship, we're kind of talking from a business standpoint. So maybe if you're a realtor or if you're a mortgage broker, do you need a company, or if you're doing property management in some sort of way. But the biggest difference really comes down to two things. There is a potential tax savings and there is liability as well. So an incorporated company is actually treated as a separate entity, okay? And so what that means is if something goes wrong, they can only go after that entity. And this becomes really important. So let's say, for example, I'm providing any type of service and my client decides, okay, you did something wrong and I'm going to file a lawsuit against you. Well, if I'm incorporated, they can only go after my company. And I'll explain why this becomes really important in some of the structuring stuff I've put in here too. The other thing that comes up is if you're a sole proprietorship and the same scenario happens, they're coming after you personally. So what that means is your house, your car, your personal assets. So it's very important when you're deciding which structure you want to go with, you want to make sure that you don't have any liability issues if you're staying as a sole proprietor. So for example, I'll have a client come to me and say, hey, I'm starting a small mechanic shop. And the first question, I don't care how much revenue they're going to do, we're going to incorporate. Huge liability, potential issues, a lot of things can go wrong. We don't want that liability sitting on the personal side. Right? Now, the other big thing is incorporations and potential tax savings. Okay, so I do have a note here. Active income gets preferential tax treatment inside of a company. So many people in real estate, we all, for the most part, I think, understand between active and passive, right? And so passive income, long-term rentals, right? Active income when you're providing a service or actually doing something to generate. So what's nice about incorporations is up to $500,000 in Alberta of income, not revenue, but income, you actually only pay 11% in tax inside of a corporation. Now, the catch with that is if that's how you're earning your living, you're going to take out a bunch of that money and use it at the personal level to pay for your own house and your own car. And as soon as you do that, now you're paying our personal tax rates, which can range as low as 15% and up to 48% in Alberta. So it's so one of the other factors we'll look at is not only are you able to earn income inside a company, but can you keep money inside the corporate structure? And if the answer is yes, then there could be added benefits to having an incorporation. Now, one of the other questions that I got posed was bookkeeping tips. So I kept it very generic here. Bookkeeping can be a whole presentation on its own, but some things to keep in mind is the most important. When you're a sole proprietorship, one of the things that's nice is the government really only cares about your profit and your loss. So a simple spreadsheet can suffice for the most part. You just keep track, here's my income, here's my expense. If you have GST to factor in, you factor that in. So you can keep it very simple and it keeps your costs low. Once you're an incorporation, it's very different because we have something called the balance sheet. And the balance sheet, because it's a separate entity, we have to pay attention and actually understand what assets do we hold, what liabilities do we hold, right? If we own a property inside a corporation, that's an asset that we need to track inside of a company. So when it comes to bookkeeping specifically, what I've said is if you're incorporated, you probably want to look at a software, right? And some examples are like QuickBooks Online. Another popular one these days is called Xero. Some people might be familiar with Sage or Simply Accounting. Yeah.
For incorporation and QBO, how much detail do you want your client to go into? Do you want them to like classify all the transactions in the journal entry, or do you prefer that somebody send you a bunch of PDF and send it out?
It depends on the client. So we offer both services, right? So it's mostly up to you on your end. What's nice about these softwares, they are getting really good from an automation standpoint. So for those of you that are not familiar with QBO, or those that are, what it can do is a lot of times it'll feed into your bank. So you go tomorrow, you buy Tim Hortons coffee using your company credit card, it will pick up that transaction in your books. But what was your name? Sylvan's talking about is in QuickBooks Online, it doesn't necessarily know what that's for. It just knows you went to Tim Hortons. So it'll say Tim Hortons and you need to come in and say that's for my meals and entertainment expense. So a lot of times it's easier to do on your own, but we have a lot of clients, they just say, this is not what we do. We're too busy. You deal with it and we'll pay you to deal with it. And we've got a team of bookkeepers that can do it. So really it's a cost versus time thing that initially a lot of people getting going will do it themselves. But once you get to a point, you're probably making more money doing your service or your business that you're just like, hand it off, somebody else deal with it. And if you get to the size where you got a big enough company, you'll just hire somebody internal to do it, right? So on the incorporation side, I put one other note there saying track each company separately. This is something from experience. I've seen a few people that just because the software start costing more and more, what they try to do is say, okay, I've got 3 companies, but one of them's not really active, so I'm just going to try to lump it all into one. You can't do that, right? Because even on the personal side, if you've got a company, you don't want to be putting your personal transactions and recording it in there, right? Each entity is its own. So if you have a corporation, that's one company. If you have 3 corporations, that's 3 separate accounts you need to be doing bookkeeping for, plus your own on the personal side. So it becomes really important to differentiate between the transactions. And one of the biggest tips basically is stay on top of it. I have had clients come to me 5 years behind and it never looks good because you never think you're going to owe as much as you do owe in tax. And a lot of people tend to say, okay, I'll do it at some point when I have time. And then by the time you have time, it's when CRA is calling you saying it's time. And then by then it's a little too late. So my best advice on bookkeeping, start early and start often. It's not a difficult task for anybody. It's just a matter of actually sitting down and doing it. And for sure, like in our firm, we'll offer our clients training. We'll say, come sit down with one of our bookkeepers for a couple hours. We'll show you what to do. The most important thing, just stay on top of it because it's very easy to fall behind on the different taxes that we have to pay. So the next one, I wanted to touch a bit more on active income versus passive income, and I want to touch on specifically around real estate. Okay, so as I mentioned, when you're in a corporation, you only pay 11% tax on active income up to $500,000. So what does active income look like from a real estate standpoint? Well, there's a couple big ones. Those that are flipping houses. So you buy, you fix up, you sell. That's active income. You're doing some work towards the property. If you're going to build, you're building, you're selling, that's active income. The other one that's interesting on here that I put is short-term rentals. So right now, anybody who's doing Airbnb or VRBO or any of the short-term rentals, that's all classified actually as active income. And that's really beneficial because some ways you look at it as rental income, but from the government standpoint, that's active income and you can get a preferential tax treatment inside of a corporation.
I have a question. Is it up to 28 days that is being considered short-term rental?
Short-term rentals they consider it up to 80 days. Yeah, I think it's 80 or 81 days, somewhere around there is their actual guideline. So yeah, anything up until that point is short term.
So Airbnb come under short term?
Yeah, Airbnb is pretty much mostly short-term rentals. Unless you go over that threshold where it's an 80, 90-day rental, then they deem that to be long-term, which then again becomes passive income. Yeah, go ahead.
Sorry, two-part question. So what's the tax rate when you go above 500,000?
Mm-hmm.
And when you're saying 500,000, is it like your net income, like revenues minus expenses?
Absolutely. Yeah, so it is revenue minus expenses. So it's your net income or what we call taxable income, because sometimes that looks a little bit different. And then once you go above the 500,000 threshold, so you're at a 27% rate federally and usually 10% provincially. But I'll just touch on that. So when you do go above $500,000, what happens is the type of income you take out personally changes. So you can actually get preferential tax treatment on the personal side then, which becomes a bit of an advantage.
So you're still paying 11% on the first $500,000.
Correct.
And then whatever excess you have, you're at that 27%.
Yeah, you got it.
How do you classify a last 2 months rental, like kind of staying for extended period of time, say 1 year, 2 years?
Yeah, that's considered passive and long-term. So anything like passive income here is long-term rentals, interest income. Some people might be doing second mortgages where you're doing the lending. So all of that is considered passive income in nature. And you'll see there, when they're taxed within the corporation at 46%. But that doesn't mean it's not a good idea still to do it through the corporation, because what happens is when you pay out a dividend to yourself personally, the company actually gets a big refund in taxes. So the government's done a really good job to say they don't want you to pay extra tax when it comes to your personal level. At the personal tax rate, that's where we typically are at our highest rates of tax we pay. But what they do is they say we're going to affect the timing of when you pay the taxes. So on passive income, they don't want you to get the tax breaks because they say, well, you're not creating jobs by earning passive income, right? So you pay the higher taxes in the company, but then you get a refund in the company when you take in and pay your personal tax on it. And so where this still becomes advantageous, and I'll touch on this in a little bit too, is when you're earning corporate dollars, by keeping it in the corporate structure, you can actually take advantage of having more money available to then invest.
Dividend income would be considered active income?
Dividend income is considered passive income, but there is slightly different rules around it depending on how, like if you're earning stocks and you're getting eligible dividends, they come into the company and can transfer out at the same way. So there is a little bit of dividends get a little bit funny in terms of the tax rules specifically, but generally they're considered passive income and you're going to be at similar tax rates there.
How much is a dividend right now that you can write yourself from a real estate corporation?
So there's no limits on the dividends you can pay, but they look at something called safe income, okay? And so safe income is a new term that's always kind of been there, but nobody really followed it until recently when changes came in. And safe income is considered the actual profits and income you've earned in a company. And so, for example, if your income at the end of the year is $50,000, you could take out up to $50,000 of dividends. You can't go and say, okay, I'm going to take a $70,000 dividend in that year.
You say 11% taxes is total
Yes, yeah. So our corporate small business rates are 9% federal, 2% provincial.
The after the advantage of the passive income, if it's 46 initially, but then there's benefits after.
Mm-hmm.
Is that dependent on the dividends you're paying yourself?
Correct.
Right. So where would that 46 on average come down to essentially? Like would it compare to the 11?
It would be, yeah. It'd be close to that 11% once you pull out and pay on the personal side, yeah. So that's why the goal for the government is to always say they never want to double tax you in any way. What they want to do is they want to take the income and basically tax you at your personal level. And so that's where they say the advantage is not going to be there in the corporation, but once you take it out personally, then the company can get a refund because you're paying the higher rates on the personal side.
Can you set up multiple opcos to lower the taxable passive income and potentially turn it into active income for different opcos?
Unfortunately, yes and no, I'll say, okay? So there is something considered connected or associated companies. And so associated companies, you're sharing that $500,000 limit. Now, when you have partners in different businesses, then that can change. Because, and the rules get very specific in this area, so I won't go into too much detail. But for example, if I have a third of this company with 2 partners, and then I have a third of this other company with 2 other partners, then they both get their own small business deductions because I'm only a 1/3 partner in each one, right? But if I had more than 50%, then that automatically becomes combined with all my other companies that have more than 50%.
Can I opt out 100% of income as a dividend to myself?
So can you take $100,000 dividend, you mean?
No, 100% of my income. Can I take all that as a dividend, or I have to keep something in cost?
No, you can take 100% of your income out. And the only thing is, it depends if it's worth it or not, right? Because the more you keep in your corporate structure, the more cash you have available to invest at a lower tax rate. Because the more you take out personally, the more taxes you pay. All the time, my clients will come back, and I was having this conversation with somebody yesterday, and they're like, I'm paying tax at the corporate level, I'm paying tax at my personal level. How do I save taxes? And my answer is usually, stop taking the money out of the company. Keep it in the company, and you'll be content you're only paying 11%.
Passive.
Passive income is a different story. It's on the active income for sure. Passive income, sometimes we'll look at saying, okay, you know what, let's pull that out. And it depends on what your corporate structure looks like as well, right? If you have active income coming in, passive income coming in, then typically we'll dividend out the passive income, get you the refund money back. So there's a lot of different scenarios that can happen and a lot of different tax loopholes. I've kept it obviously very general and high level for the purposes now.
Just for the sake of like explanation, if I want to buy a property,
Mm-hmm.
would it be better? I don't know, but what's the best strategy here? Would you lend yourself out of the corporation and buy it on a personal level, or would you buy it inside the corporation, knowing that you will get higher interest rates?
I'll
for
come
loan?
back to that one because I've got a slide on something similar. So yeah, keep that in mind.
Perfect.
See, right here. So this is something I recommend to a lot of clients that want to go into real estate. And I call this the 3-tier structure. So the way the 3-tier structure works is you'll see there's 3 companies: Holdco, Real Estate Co., OpCo, Management Co. Each of these serves its own purpose. And this accomplishes your tax savings and your liability protection. Okay. Now this is a basic level. There is ways to go one step further depending on what you do with like things like family trusts and things like that. I won't touch on that here. It doesn't apply to most people, but in this structure, what we do is we say, let's say you're doing an active business. Let's say real estate, for example, okay? And that's your main source of income. Well, we might set up an operating company that's a real estate company. So you know what, we earn real estate income, make, I don't know, a couple $100,000 for the year. You can do that as a tax-free dividend to your holding company, okay? So what's nice is the holding company can actually get a dividend and pay no additional tax. So you made $200,000 or $100,000, you move it up to your holding company. Holding company now has $100,000 tax-free. Why we want to do this is a couple reasons. One, the real estate company carries a little bit of liability, right? And you might have insurances and things to offset, but in general, when you're providing a service, there's liability that can be created against it. So what we do is we move it out of that company and we move it to a place where nobody can come and get you. And that's your holding company. My one rule with holding companies, it doesn't do business with anything you don't control. So the example I give is you might say, hey, Irf, you know what? I really like this building we're in and it's for sale. Why don't we partner and buy it together? Well, we're not going to do a partnership between holding companies because that creates liability. We had set up a separate corporation that our holding companies can be shareholders of to avoid any of that liability attachment to holding company. So then your holding company now has some cash. I'll come back to your question in a minute here. So your holding company has cash. You can lend it to the real estate co. Okay. Now what's nice is you lend it to real estate co. So real estate co can buy property. Okay. You've only paid 11% tax so far on your income, right? Because of that, on the real estate income. So your real estate company goes, buys property, rents it out, let's say on a long-term basis. It's going to earn passive income, but you can also pay a management fee to yourself to manage those properties. Now you can't go and say, okay, I'm going to pay a management fee of 50% of the rent, but something that's reasonable depending on what you're doing, but 10%, 15% sometimes, you can pay a management fee back to your operating company. So that management fee is essentially taxed at a lower rate because again, that's active income. Now whatever's left in the real estate company, yes, you're getting passive income, but we dividend that to your holdco and that's the money you take out personally. So there's a lot of different ways to play with the structure, but what this structure accomplishes for you, it gives you liability protection because your operating company stays very clean and with very little excess cash or assets. It gives you a holding company that allows you to invest, right? And your holding company can do lending, it can do stocks, it can do anything that doesn't create liability, right? Or you can lend it to a separate real estate co. And some people might say, well, you know what? I've got another project. I'm doing a multi-family build. Well, your holding company can go set up another company, right? You might say, okay, well, I want to own shares in this other business. Well, your holding company can do that. As long as it owns more than 10% of the company, more than 10, not 10, then you can do that tax-free dividend, right? And so that's where this structure can become very advantageous for people. The example I give for those that were around during the boom of basically 04 till 08 when Alberta was booming, we heard the biggest news story was that there's these contractors coming in, overnight contractors building houses, and then they're selling these houses. They've done a crappy job building them and they leave and nobody can go after them, right? Well, this structure kind of led to that, and unfortunately, and it's a bad example from a bad use of it, but what was happening is people would have an operating company that's building property, and then they would go sell that property and close down the company. So they're not attached to any liability that comes from future with that property, right? And the structure is still being used. They've just offset it with obviously the new home warranty program. That's an example of how you're protecting yourself from any potential liability that can come. And if somebody comes and sues that operating company, you can just close it down because there's nothing in it and go open up a new one and start up your business again. So this gives you a lot of flexibility in terms of what you want to do.
Just to clarify, who's paying management?
The real estate co, because that owns the property. And of course, if you're managing, you might be managing other properties, right? So then you'd have
Holdco doesn't own the property?
Holdco does not. The real estate co does. And the reason for this, I do this with all my clients, is they might say, okay, you know what? I'm starting with real estate. I want to buy one investment property, and I want to put it in a company. One property. My question always comes back and says, well, what's the long-term plan? Are you staying at one? Are you going to end at 2? Do you want to grow to 5, 10 properties? If it's 1 or 2, you might put it in the holdco. There is, with real estate, there's always a little bit of liability. You might have a basement suite that's illegal, that's not done up to code. Something might go wrong inside. You might get somebody slip on your sidewalk. Like, there's a lot of different potential things that can happen. So if it's 1 or 2 properties, maybe from a cost analysis, we might say I'll keep it in my holdco. But if the focus is to grow that real estate portfolio, then I always say you separate it. And a lot of our clients that have multiple projects, things like that, they have multiple real estate codes because they'll have multiple real estate codes. Yeah.
Is it partners or
different partners, liability, financing. If you have 100 units, if you have them all in one company and something goes wrong with one of them, they can go after the other 99. I had one client doing rent-to-own projects, and because the liability with rent-to-own, whoever's done those, is a little bit higher because you're dealing with 2 separate parties and lots can go wrong, every property was in a separate company.
But then if real estate company does the business and the creates active income. Why would they keep the properties in that company?
Real estate does not create active income, it creates passive income.
But I thought the real estate co is the one that does flips and all that.
No, that would be more on the opco management co.
Oh, I thought
So if you're in like a business, if your business is flipping properties, that activity would happen in the opco.
So flipping Airbnb, you keep it there long term.
Yeah.
You keep it there.
And you can keep the property in the real estate co, but the act of the management, because the management of the property is what creates liability. So the management services, you want to push the liability to another entity.
So you buy the property here, but this is the company that's renting on Airbnb.
You got it. Yeah, on your leases, it should be that company, right? If you're doing any long-term leases.
The op company and the operational company puts it on Airbnb and like sublet it.
Correct. Well, not even sublet it, like that one can just act in a management. So for example, if I go hire an external manager and something goes wrong with the property, I'm going to go after the management company. So you want to push the liability over to the management company.
In the case of flipping, who owns the property?
In the case of flipping, it depends on the timelines on it. If it's a short timeline, you would do that inside of the same corporation selling it, inside of there, if you have no other business or no other liability attachment to it, right? Sometimes if I've got clients doing multiple things, we might set up a separate business for that.
They can move 100,000 K to the whole co.
Yeah,
The same way.
exactly. You got it, yeah.
Yeah, I have a structure like that. I
Perfect.
have a quick question, I'll just shoot them up.
Yep.
So the first one is you said that in the old code you keep your cash and stuff you control.
Mhm.
So like would you consider okay to put like a Canadian REIT and I have stocks like S&P 500 stuff there?
Yep.
That's okay.
That's
right?
okay, yeah, because
I'm not selling anything from there,
Yeah.
it's just owning shares.
and there's no liability. That's the catch,
That's the catch.
right? If I own shares of Suncor and Suncor gets sued, I might lose my money, but nobody's coming after me. So you're okay doing anything that's from that standpoint where there's no liability.
You mentioned that that we can move dividend from the opco or the real estate co to the old co tax free.
Correct.
We have more than 10%. So what changed in 2018, 2019? Because my accountant at the time had me to send a letter. He had me to send a letter to the Minister of Finance objecting some kind of change about throwing dividend around.
Yeah,
So did they do that? What happened?
they did. So prior to 2017, when a lot of those tax rules changes came in, a lot of people were able to just have 1% ownership. And so with a 1% ownership, you would be able to still do a tax-free dividend because they're considered connected. What happened was, as part of those rule changes, they started to say, no, it has to be more than 10%. And so now if it's less than 10%, you don't pay out that dividend, as it could create double taxation for you. So if you don't have more, like if you have this structure from prior and you don't have that 10%, then you need to look at doing some restructuring so you can get that extra percentage in there, for sure.
So what is the
Oh.
difference to move the money, the dividends from the op or the sell to the whole co?
From real estate co or from opco?
For me to get money.
For you to get
What
money?
is the difference between taking the money out of the opco or the
Holdco. So the difference comes how you get paid. So there's two simple ways to get paid: salary or wages or dividends. You got it. And so if it's salary, that has to come from an operating company because it's an expense for the business. So you don't want to pay yourself a salary necessary from holding company unless you have enough income coming from there, right? So you might do it from your operating company and pay a salary. Now, if you want to pay dividends, and I'll explain the difference between the two, dividends can be only paid to shareholders and they're after-tax profits. So part of the taxes is paid in the company and the remainder of the tax is paid at the personal level. So dividends have to come from the holdco because that's what you would own. The difference between taxes between the two is very minimal. Where the factors come in, there's three big things that can impact people. If you want to pay CPP, you need to be on salary. So if you take dividends, you're not contributing to CPP, which means you don't get CPP when you retire. Whichever way, I've got clients 50-50 on that one. RSP contributions, if you're on salary, your RSP room limit goes up. If you are on dividends, your room limit doesn't go up. I'm not a big fan of RSPs, but there is some small purposes for it. And then the third one is childcare. And this is one that a lot of people miss. But if you are, if you've got young children and you've got childcare, If you are taking dividends, they don't look at that as working income. So you actually don't get to claim the childcare expenses against it. So if you have children, then you want to probably be on some sort of salary so you can claim the childcare expenses to offset it.
Also, salary
Okay.
is better for childcare expenses.
For childcare, yeah, because what happens is your childcare deduction goes to the lower income earner based on earned income. Dividends isn't deemed as to be like your earned income; it's considered investment income. And so, if you have only dividend income, your earned income zero, and then you don't get to claim your
But you also
childcare.
don't want to be having a high salary, so it takes away the childcare.
Correct. Exactly. Yeah, it's always a game every year.
But as soon as the Holdco get $100,000, they have to pay tax.
No, if OpCo pays Holdco 100,000, you can keep 100,000 in Holdco. You don't have to pay. You can pay 50,000 to yourself for personal income, and you can keep 50,000 in Holdco to invest.
From liability perspective,
Mhm.
it's better with incorporation than individual.
Correct.
But from taxation perspective, I think like many people say if someone owns more than 5 properties, then it makes sense. But less than that, the individual bracket, because it's taxed at the individual bracket, and also if the properties are individually owned, can they be transferred to incorporation later on, or?
Yeah, so I would say it depends. I don't like that 5 property rule because it really depends on what other income you have, what you're doing, how you're investing, the liability associated with it, and what you're doing. So I wouldn't say if you have more than 5, then go corporation. I would say you got to look at your overall picture. Can you move a property from your personal to the company? The answer is yes. You can sell it to the company. And when you sell it, if there's a big gain, you could be subject to taxes. Now, there is a mechanism, we call it our Section 85 rollover, where what we do is we move the property into the company at cost. So it is doable, but just know like typically the cost to do this is a little bit higher because you need to have tax lawyers and accountants involved on the transaction, but it is doable for sure. So sometimes we've done many of those and it makes sense to move it to the corporate structure. So
I think it's probably important to ask the other question. If you ever have to move it back from the corp to personal,
yeah.
and sometimes often you have to do that for financing, because especially until you have a very large portfolio, it's far easier to qualify personally. Then there is a tax implication that you can't roll over, if I understand that correctly.
So what happens so anytime you move property, it has to be done at fair market value. Now, from a financing perspective, CRA looks at what we call beneficial ownership. Banks look at what we call title ownership. So what's nice about this is you can own property under your name, you can get financing under your name, and you can create this beneficial trust. And when you create this beneficial trust, now you're still getting your financing and you get to still claim it all through the company. And so that's how we get around that piece there on the side of needing to keep it in your personal name for qualifying purposes.
You know, what I'm saying is if you actually take a personal property and then move it into a corp,
yeah,
you could do so tax free. There's no way to do that. But if you take it from your corp and move it back into your personal, if you have to do it for whatever reason, then you are subject to
you're going to be subject to capital gain through the corporation at that time.
Really compelling reason to move it into the corp. Sometimes it can be disadvantageous because quite often finance it, we have to move it back to the personal.
Yeah, and that's why, like, when we're financing it, a lot of times the title can stay on the personal side, but the treatment of it for tax purposes is still through the corporation.
Yeah.
Right? So then
legally it's under your personal name.
So there's an agreement that we can create called a beneficial trust agreement. And that agreement says that the property's in my name, for example, in trust of my corporation. So CRA says who's the beneficial owner in that instance is the corporation. So taxation happens at the corporate level instead of the personal level. So yeah, I completely agree. Like financing wise, a lot of times when you're getting going, it's easier and makes more sense to get it under the personal name. And so the way we do this is we still set up the same structure, but what we'll do is we'll end up doing this trust agreement. So for financing purposes, I'm getting the lending on my name, but from a taxation standpoint, I get to still take advantage of the corporate structure that exists.
Question following that. Let's say if you die, you have multiple investment properties, then based on CRA's rule, does your corporation pays the capital gain or does your personal pays the capital gain?
Both. No. So the big one is actually, if you die, your estate is subject to tax. Your estate in this instance, you own the holding company. So you would pay taxes at your personal level on the growth of the value of the shares, not on the property itself. But if you went and sold those properties, then the company would be subject to the tax. So if the estate went and sold them, I should say.
Another question on the tax-free capital gain dividends wasn't too clear. Let's say if the whole owns 50% of your real estate co,
Yeah.
your real estate co has a 200,000 after-tax revenue,
Mhm.
then does that mean you can pay 100,000 into whole co as tax-free dividends?
Depends on how it's set up, yes. But basically what you're saying is correct there. There could be the potential that you could take a little bit more out, but essentially if you have 50% and real estate has 200,000 of profit, 100,000 travels up to holdco tax-free.
So would you advocate someone owning properties in their personal names into like a real estate co as soon as possible? And also on the financing side of things, when you are trying to buy properties under your corp, I know you're not a mortgage broker, but if you could quickly touch on that, right? Like how does it differ and what are they looking at?
For sure. So the first question you ask, the answer, like I say very often, is it depends on your situation. Sometimes if you're saying, you know what, I own a couple properties, I have a job, I'm making my income, the corp structure probably doesn't make sense for you, right? It's more when you're doing some sort of business that then you don't want to take that income out to buy the property. That's where the structure becomes more beneficial. You do have to consider if you're going to own 20 properties, well, there's liability attached to that. So maybe again, now you're doing it as a business, you move it to the corporate structure. From financing perspective, it is easier to get financing on your personal name. And so again, that's where you basically keep it in your personal name, but we do the trust agreement to treat it through the company, right? And even then, I know, and you can probably speak better on this, but the rules are tightening up. So you have to make sure you got to get creative on that side and find the right lenders that you're going to work with that'll still finance you, because some are now coming to the point where they're saying your income needs to still be reported for us to treat it under your personal. So they want to see the income on the personal, but there are still lenders that will say, no, I don't care. I just need to see that you're making money on the property and it's rented, whether it's through the company or not. I'm in the middle of purchasing a property right now and I'm going through that situation. A couple lenders said no because it's not under my personal name, but we're working with 2 lenders right now that I'm waiting for them to get back to me saying, yeah, I don't care as long as show me where the income's coming in. And I showed them my real estate co and they see the income and they're like, yeah, that's good enough for me.
I'd say to add to that, I'll just jump in here. I'd say you're probably cutting your options down by 75%. Like you're going to end up with 1 out of 4, 1 out of 5 lenders that will even consider it. Once you're at 20, you're doing
different story.
Anyways.
Yeah.
But first 5, 6, 7 properties, far easier to keep it in your personal name. Make sure you have $2 million worth of liability. Like you hit the nail on the head. If you've got an operating company,
different story.
You've got a lot of money in that company, starts to be beneficial. So because if you need $100,000 for your down payment, you don't, in order to have $100,000 in your bank account personally to buy a personal property, you've got to pull it 140, 150. So it eats up a lot of your cash. But if you do the bear trust agreement, you can sometimes work around those.
Exactly.
So, you know, that's a very legitimate reason to do that. Otherwise, it does get more complicated because they look at your T1 general and say you're not claiming it. You can show them your financials and they say, I don't get that. And a confused underwriter just says no.
Yeah.
And when you're dealing with an underwriter for residential, they're not commercial underwriters, and commercial underwriters don't want to deal with you. They have 2 or 3 rental properties.
Yeah.
So it becomes challenging. So, but yeah, otherwise, everything else you said makes perfect sense. The fair trust agreement is the way to get around
make it work.
Pool of money you have that you want to use for your down payment.
Exactly.
So you use the corporate money to do the down payment is the trust agreement?
Yeah.
You don't take it out as personal income to pay under your personal
Exactly. And that's where the big benefit comes in. That's why you don't see this structure for somebody who's, I'm just working a job and I want to have some couple of real estate properties. It doesn't make sense, right? You're cutting down your options. You've got extra costs with the structure and you're not getting the benefit because the passive income is going to be taxed higher inside the corporation. But
as a consultant to consulting
then you can take advantage of this because then you're not taking that extra income out as a dividend and then paying the extra tax on it, right?
Where would the liability fall if you have the beneficial trust?
Again, you want to push the liability to the management co. Right? So again, you want to basically have it where you've got the management agreement in place, make sure the tenants are signing agreement with the management company. So then if they sue anybody, they're suing the management company at the end of the day.
So to summarize this, you have the cash on the holdco, the properties in the real estate, and the liabilities in the operation company.
Pretty much. Yeah, you got it.
Can I have a salary and a dividend at the same time from a corporation?
You can, yeah. Yeah, if it makes sense. So some people might say, you know what, I want to pay some CPP, so I'll do a small salary, or we want to claim the childcare, so I want to do some salary, but the rest of the income I want to take as a dividend. You always have to play with it and see. Every situation's different, so.
Sorry, last question. Just wondering, that Section 85 rollover you were mentioning, right, like at cost, is there a limit to how many you can do that to, and what would be rough cost of it?
So the way they work, okay, let me start at the beginning. I guess. The way they work is if you have a property in your personal name and you want to move it to the corporation, what we do is we do this rollover where what we do is we move the property in at cost. So if I paid $500,000 for the property, I move it in at 500. It's now worth 600. So that other 100,000, actually what we do is we issue what's called preferred shares. Now preferred shares don't show up on the book, but it's dividends that you have to take before you pass away. Otherwise it goes to your estate return and when you die. So that's CRA's mechanism to say, I'm giving all the value that's there today to the shareholder that's there today. And in the future, whatever growth happens can go under the new structure. Now, typically, if I'm just saying it's one property and we're moving it into a corporation, like we would charge you $6,000 to do that. If you've got multiple ones, you might have, hey, you know what, I've been doing this. I have 3-4 rental properties now. I'm quitting my job. I'm going to focus full-time on real estate. I need the structure. Then there could be other factors and other things that need to be built into all of that, right?
I went through that, then it made no sense to pay the $6,000, and I didn't sell, and I was lucky because the market value was low. But just by curiosity, how can what is to be done for it costs $6,000?
So there's two components to it. There's a tax component and a legal component. So there has to be what we call a rollover agreement created, which the tax lawyers do. And then there's the tax filing with the government for that. And part of it's also the liability because they're higher risk with CRA. So there's a higher chance for audit, which means you got to defend the transaction and things like that. So that's why the cost is so high on them. But you're right. If like when the market value is low or like right before the market really takes off, I had that discussion with a lot of clients is saying like, if you want to move it, now's the time because you don't need to do the rollover. We just sell the property to the company and you don't have to pay this expense. You wait 2 years from now, the price has gone up 30%. Now you're going to have to spend that money if you want to do it. So timing it is correct.
You wouldn't claim a loss or anything.
No, you typically won't. Like there was some instances where the markets had gone down so much that we did claim losses, but you have to always support your assessment. So every time we do this transaction, we get somebody to come in, do a CMA, for example, Santosh, and then he would do a CMA, and then you would basically be able to say, this is the value, the fair market value of the property. So if CRA comes back, you can defend that position anyways, right? Yep.
Sorry, one last one. Regardless if you as a person owns it or real estate co-owns it, can you somehow claim a depreciation at all if it's 100% rental property?
Depreciation, okay, that's actually a good one to move to the next page. See, it's there. Okay, so I'll start bottom up, I guess. So depreciation, or CCA as we call it, is very interesting from real estate. So what happens is CRA has come in saying, when you buy a fixed asset, it's going to last you longer than a year. So why are we going to let you write it all off this year? You got to write it off over time. So a house is a good example. A house, you're going to buy it, it's going to last you many, many years. What they've said is they've set rates, and typically your houses are about 4% a year. You can write off as a deduction. Now, I caution a lot of people on that though. When it comes to real estate, your prices tend to go up. If you sell the property in the future, everything you've taken as a deduction for CCA or depreciation comes back as income in that year. So if you go and you have this property for 10 years and you write it off, and then you say, I'm going to sell, not only do you have tax on your capital gain, you now have what we call recapture. And so a lot of times this can put you into a higher tax bracket, or it can drain all your profits it's in a gain situation. So we don't use it a lot. Where it makes sense is somebody says, you know what, I just buy and I never sell. They might take the depreciation benefits. But when you want to do a transfer to kids or things like that, it can really complicate the transfer and the taxation on that. So for me personally, I never even depreciate any of my properties because typically they're going up in value. I'll go turning principal residence into rental properties. So typically what happens in this scenario, there's a couple things you got to be really careful of. And that is, since 2016, CRA has said you have to report any sales of principal residence on your personal tax returns, right? And so even if you turn it into rental property, you still need to disclose and treat this as a sale. If you go the other way, same thing applies. So if you move back into your property. So what's become really important is anytime you're changing the use of a property, you have to declare this on your appropriate tax return.
You can't claim the closest property you're selling as principal, then 3 years after, claim it again.
Yeah. So at any given time, you can claim one property as a principal residence property. So for example, where that comes in is we had a client this year we're working on. They had a cabin they sold, they have their house they're keeping, and we're calculating where the tax benefit was for claiming which property as a principal residence. And so you just have to be careful on it, but at any given time, you can have one property as a principal residence.
Every 3 years, correct?
No, it doesn't have to be 3 years even.
Oh, okay.
Yeah, at least a minimum, and that's the anti-flipping rule. So it's the 1 year rule that they put in. And so this one's fairly new, but the rule of thumb is now in order for CRA to deem that you're not flipping the property, you got to keep it for at least 1 year, right? So if you bought a property and 8 months later, you're like, I'm moving and I'm selling and it's gone up in value, you're going to be subject to taking that tax as income, and regular income too, not a capital gain. So that'd become regular income to you for that gain.
Not active income as a corporation.
If it's purchased in a corporation, different story, but it'd be active income for you on your personal tax return level. So you got to be very careful of that 1 year timeline now. And then the other one that comes up a lot is the Smith maneuver, where it's can you use your principal residence interest. So for example, if you have a home equity line of credit, if you use that to go and buy an investment property, then what we're doing is you're using that interest on that home equity line as a write-off against the new property. And so what really important in this is it's very easy to do, but you want to make sure you're keeping very good records, because you might have a home equity line that has, okay, I've got a balance of 300 that's from my existing mortgage. I bought a new car for 50. I took out 50 to pay for my kid's wedding, and then I'm going to take another 100,000 and buy a property. Well, you got to keep track of that, because only that 100,000 can then be written off for the purposes of the property.
You recommend structuring a separate account.
Yeah, or you can make sure you just have to have good records of it. And a lot of times too, but the trick that really makes this advantageous is saying if you've got 50,000 in cash, then what you can do is borrow 50,000 against the company to transact with the down payment. And in the future, you could put that 50,000 against the other debt that you might have, right? So you can still make it work, but it has to be very clean in that transaction.
You have to borrow his interest in the whole, you can't just borrow zero interest from your company. Right?
If you're talking borrowing money from your company, as long as you can give money to your company interest-free, but if you take money, it actually is going to become income unless there's some very specific rules. One of them that relates to real estate is if you're buying a principal residence, you can borrow money from your company, but it has to be set up as a mortgage that you're repaying back to your company or taking that as income, at least the interest portion of it. But if it's for an investment property, you can't do that. It's only for your principal residence that you're allowed to do that for.
Would it be considered like a loan and a passive income that the company is loaning you money for whatever investment or principal?
Not if it's coming to you personally, right? So that's where if you're earning corporate dollars, that structure can make sense again, because then that's how you keep the money inside at only 11% tax rate. If you take it out and you buy a property on the personal side, then that becomes income to you personally.
Oh, okay.
Right?
But I can lend it and at like a premium interest in...
No, they're really cutting down on all of that. So, because then what people would do is they just keep borrowing money from their company and just claim the interest every year, and nobody would ever claim income, and then the government doesn't get their big tax dollars.
But then they will pay taxes eventually at 46% because the corporate is making passive income
Yeah.
from lending.
Yeah, depending to what amounts. And CRA does have a prescribed rate of interest that you can do this in very specific situations. Like I said, when you're buying your principal residence, for example. But otherwise, you don't really want to get caught into that trap, because there is actually a rule. There's a specific section in the Tax Act that says that if you've borrowed money from your corporation and CRA comes back, they will make you take that as regular income, not even dividend income. So you pay the regular tax rate and the company won't get to write it off. So you got to be very careful when you're taking money out of your company to make sure you're declaring it as income.
So this is where the beneficiary trust agreement is a better way.
You got it. Depending on the dollar amounts and your whole structure, but yeah.
Couldn't they let the company to write it off? Kind of like a
Yeah, it's basically because you're not supposed to be taking money without claiming it as income. So I didn't put this on here, but one more thing I wanted to mention, two more things that really come into play here. The first one is UHT. So this is called the underused housing tax. And this is something that's brand new. As of anybody who owned property from December 31st, 2022, if you own it in a partnership, if you own it in a joint venture, if you own it through a corporation, through a trust, you're required to still file this UHT form. You probably are not subject to taxes. The tax is really targeting foreign people who own property and the property sitting empty. They have to pay a 1% tax of the value of the property. But this loophole with this filing is actually capturing a huge chunk of people that have to actually file the form. And the penalties for it are $2,500 at the individual level and $5,000 at the corporate level. So if it applies, if it's a husband and wife who own a property, that we're treating as being exempt. But if it's two friends who own a property, you need to file it. If you own it through your corporation, you need to file it. So very important you're paying attention to that. Deadline is normally April 30th to file that. They have extended it because it's the first year. It's October 31st this year. But this is going to be an annual filing for you. And then the second one that actually is becoming really important as well is we've talked about the beneficial trust. So any type of trust, including beneficial trusts, or if you have a family trust that has no activity in it, previously you did not have to file a trust return. But starting next year, everybody needs to file a trust of any kind. So you're going to have to file a trust return. So some of these structures that have been used for many years, they're becoming more headaches because there's more compliance that are dealing with them. So you have to really look and see when it makes sense for you to actually have them.
So like the way my joint venture structures,
Mhm.
in the next it says declaration of trust and it says Joe is on title and then notable loans is beneficial owner. So does that mean we have to file something special next year for all of these joint ventures?
Yep. Yep.
So what?
That one's just a trust declaration filings.
Different from the UHT.
That's different from the UHT. That's coming next. So next year, March is when you'd have to have those filed by.
March 2024.
Yeah.
They're kidding us.
It's getting crazy. But what they're doing right now is the government is basically creating more data for themselves. So now they'll know what joint ventures. So you're going to file this trust. It's going to have two partners in it. One partner's claiming income, the other hasn't been. Now they can go after the other partner, right? They just want to collect all the data that they can. And that's what most of this is basically coming from.
What if the beneficiary trust is set up in a company located in a jurisdiction that's no income taxes, passable effective? Then how does all this work?
Say that one more time. You've got.
What if, let's say, you personally own a home in Canada, but you set up a beneficiary trust with a company that's set up in a foreign jurisdiction, has no income tax, just 0% flat.
Where's the property though?
Canada.
Then you wouldn't be so they have something called permanent establishment rules. So when you have physical property in a place, it needs to be registered in that place. So you can't go and have a property in Canada and have it taxed in the Cayman Islands because the property's in Canada. It's subject to Canada tax first. Yeah.
What is the capital gain tax for second property? With individual ownership and incorporation structure.
Yeah, so basically capital gain tax is 50% of the income gets taxed at your tax rate. So if it's on the personal side, it'd be whatever tax bracket you're in. At the corporate rate, it'd be at the corporate rate based on the corporation you have. So it's 50% of the tax rate at the end of the day. When it's inside of a corporation, what's really neat is 50% gets taxed at the corporate rate, but the other 50% gets something called CDA, capital dividend account, that you can pull out tax-free. Because again, CRA is saying at your personal level, you get half of it tax-free. So at the corporate level, they have to be able to flow half of it back out to you tax-free. So that's how they do that. But essentially, you pay capital gains, half of the gain, you pay tax at the appropriate rate.
And the other half you can take as personal income, no tax.
No tax, yeah. But it doesn't actually show up as income. It just gets treated as a dividend, but it's it doesn't show up as taxable. So your income doesn't actually increase, and that's how you avoid the tax on it.
Capital gain is 100K, then the actual gain for the person as individual level is only 50K.
Correct. And then whatever tax bracket you're in, you pay the tax at that rate.
On 50K.
On 50,000, yeah. Yeah.
What are the minimum months per year I have to keep my principal property? So once I sell it, it will become a tax-free property.
Yeah, so 1 year. 1 year now, 12 months. There was one more other thing to note that I didn't put on here actually is GST. So anybody that does short-term rentals, you have to be very careful. The short-term rentals are subject to GST. So you have to pay GST on them. But the catch comes in when you sell your property. If it's been predominantly short-term rentals, you would have to add GST to the sale price. Same thing if you are substantially fixing a house. If you go buy a house, gut the whole thing completely, they're going to treat that as a new property and you'd have to be charging GST on it again. So you have to be very careful. There are some little ways to avoid it depending on your situations, but something just to keep in the back of your mind if you do short-term rentals.
How does the taxation compare as a whole if you've got a corporation with passive real estate income, a long-term rental, and you take all the money out of the corporation, right? Essentially, you're not leaving anything, you take it all personally, versus owning it personally and just getting taxed after.
Yeah, so in that case, if it's all passive, the rates will come out to be pretty similar depending on your tax brackets. There might be a couple % advantage to having it on the personal side. But so that's exactly a good reason why, if you're earning employment income, you don't need that 3-tier structure because there's no benefit to having it at the end of the day. You're paying a higher tax in the company. Unless you're doing something in an active business form, that's where that comes in because that's where you can still see some of the benefits. Thank you guys for having me and thank you guys for inviting me out. And thank you.